Now that we've covered the kind of that global overview, we can dig in a bit more into the U.S. and some of the recent data points that we've been kind of following and tracking on the leading side. Present case, and where do we think that's gonna put us over the next couple months? So this is just looking at high frequency data. You can obviously see new COVID cases continue to rise, COVID deaths, all pointing towards a lockdown index that's going to remain elevated. Jobless claims will continue to get worse through January now that we have more states that are going to report, given the holiday slowdown. And now we have had new announcements of furloughs and some layoffs. So again, those are things that are going to continue to be problematic as we go through really the first part of Q1. We don't see that really cooling off into February, and then March is we have a lot of debt that's coming due. The question is going to be, can they roll it? Will we start to see additional price cuts or slimming of the companies in general? And that's going to be a problem, especially as we look at just what are those jobs going to look like? And we'll talk about that again in segment 3. We've shown this before. We're just going to touch on it quickly again. Foreigners continue to be a large owner of U.S. corporate stocks. If countries start to need, or foreigners start to need more dollars to get away from their currencies as inflation takes hold, this could be a big problem if you want to consider who is going to be the net seller of some of our equities, just based on who is positioned. Again, when we look at defined benefit plans, retirement accounts, IRAs, those are things that are fairly stable. The biggest component is going to be foreigners and taxable accounts to see how those adjustments are, because we know, based on what we talked about last week, people are very overweight U.S. equities, large caps, small caps. So there is a lot of potential movement just given the amount of ownership as we go through and look at the different markets. Now, when we look at zombie companies, the outperformance has pared back, but they continue to remain elevated when we look at just how the activity has been. You can see in 2008, 2009, how things have shifted in terms of, that dash the trash, if you will, back in 2009. We continue to see a movement into those zombie companies that grab for beta, some of those momentum stocks, some of the algorithms and quants looking to find some of that beta, which really kind of drove up some of these zombie company movements, but that started to pare back over the last couple of days. The bigger issue is when we look at the tech sector, which is now has about $1 trillion market cap with negative earnings. The negative earnings, at what point does money matter? What point does it make sense to be profitable? So as we see the market caps continue to accelerate on the negative earnings side, again, this is the bigger issue overall when we look at total market cap and just negative earnings in general. Again, when we look at just the health of the economy, the health of market prices, and just given where the economy sits, will these companies be able to turn a profit in 2021 if we continue to see some of this slow rejuvenation that continues to be fairly, not to be redundant, but again, these are things that we like to look at. And then, as we said in the first segment, the gamma exposure, the Daily Shot, I thought, had a really good chart showing just how the gamma exposure has increased and gamma is the rate of change of delta. So delta is the stock, if you're looking at options, and gamma is the rate of change. And there is a lot of exposure to gamma. So the question is, if there's a lot of exposure to gamma, could we get a vol spike? And if we get a vol spike, you're going to see a hedging on gamma, which is you're going to see a lot of delta or stock being bought, which again is going to drive the stock market in one direction, because we are at these extremes. This is going to be something to watch. Not to get too technical, but options are priced off of 4 different metrics. You have delta, gamma, vol, and then theta, time. Again, these are things to consider when you're looking and if you want to own options. So now when we look at that business optimism, now there's a certain amount of politics that come into this as well. But optimism can miss to the downside in terms of where things are going. for small business. Optimism, it was expected to be at 100.2. It came in at 95.9. That continues to shift lower. The bigger issue is really the general business conditions, which is now down at negative 16. There's a view where, and this is where we look at inflation. So small businesses are saying they're grossly undersupplied on the inventory, so they're going to continue to buy. They're trying to push through price increases, but they're not hiring, and they don't feel all that great about CapEx and about the business conditions going forward. This is going to weigh on U.S. economic activity, and as long as they're either not hiring or not planning on hiring in the next couple of months, this is going to weigh on just wage earning, again, the joblessness, the unemployment, which is going to be a bigger problem as we head into the end of the middle into the end of the year. And when we look at municipal borrowing for new projects, this is something that we think is going to increase. Their municipalities are going to look to capture low rates, but at the same time try to generate some activity in terms of infrastructure, because we desperately need infrastructure, which is why we're doing our private equity fund the way we are. We need to see infrastructure being built, and this is a key component of it. So this is going to be a net positive for jobs to try to offset some of that. So we see small businesses pulling back. We should start to see municipalities and federal start to see that expansion, and it'll be more geared towards infrastructure, which hopefully will be some of that longer term growth as we start to expand. The issue coming back to is that trade balance. Goods and services, we're again shifting to new all-time lows, or that space in terms of that trade balance, and just based on what we're seeing in inventories on the large scale, small scale, this is going to remain elevated as our imports will remain strong in order to bring in and try to backfill some of our shortages on the inventory side. Exports continue to point up, but they're massively underperforming the import side, which again is going to keep our trade balance fairly unbalanced and will weigh net on GDP. And then when we look at the inflation side, so inflation continues to it tick down a little bit, but again those PMI price continues to push up. And that's what we want to keep talking about, is that you can see that PMI is that leading indicator. So we had PMI in 2009 start to spike up, and then we had that inflation follow. In 2016, we had PMI start to push up, and then we had inflation follow. This is why we're so concerned about the rapid move up in terms of those supply disconnects, the issues when we're looking at inventories. This is going to push inflation higher. So when we look at CPI, just to look at what those numbers are on the left. So CPI year over year is up to 1.4%. It was expected to be at 1.3%. Ex-food and energy is at 1.6%. Again, we'll show in the next segment why it's actually much higher. But again, these are things that continue to weigh on the consumer, who is seeing wage pressure, is seeing cuts in as they've maybe been furloughed, or they've had their salary cut by 30% because the company's trying to save capital. These are things that are going to continue to weigh on purchasing as these price increases continue to get pushed through and moved onto the consumer that doesn't have that discretionary income. And that's when we look and inflation forwards. This we've showed this in multiple different ways. This is just rehashing the fact that the 10-year break-even has pushed higher, and now when we look, it's back above that 2%. The U.S. 10-year bond yield, which is on the right-hand side, is at that 1%, but the break-even is now back above 2. Again, this is why we think that when you look at how this normally moves, we get the 10-year break even moving up, and then the yields follow, which is going to technically, or it should, put pressure on equities in general as we start to see some of this swing. Now, when we talk about and we really hone in on that PMI, this is global PMI. So on a global level, inflation hits near decade high with input price and output prices inflation is moving and the input price is going at a faster rate, which is going to cause output prices to be shifted up. You can only subsidize so much, which is why this remains the biggest issue when we look at inflation in general and what the expectations are, and why this number continues to lag or lack the what we expect to see not only into January, but February and March, as we start to see the push through. Again, in the U.S., input prices are at north of 70. We're at the highs that we haven't been in at 10 years. When we look at globally, it hits a near decade high, something very similar. And when you look at China, India, Japan, South Korea, with a lot of export markets that have seen their input prices increase, specifically in China with iron ore, coal, steel, you can only keep those prices flat to be competitive in exports for so long, because again, you're subsidizing it to maintain your place and the market share that you've taken, which is why we've talked about how China has spent, or it costs 1.2% of GDP to subsidize, to maintain your export level and market share. Eventually, as that pain continues to rise, you're going to have to push through those costs, and that will result in a shift in your export numbers. But when we look at economists' expectation for inflation, the Fed target is at 2%, and actual forecast inflation for 2021 remains below 2%. So again, there's this disconnect between where is in inflation and where is it expected. As we have crude at 50, we have WTI at 53. Gasoline prices are up. Diesel prices are up. The year-over-year comp is going to get harder as we see an increase in energy prices, because right now inflation has been kept low because of airline tickets, because of concert tickets, because of energy prices. And when we start to look out and peel back the onion and look at food, prepared food, grocery stores, when we look at clothing, as we see cotton prices exploding up. Now the U.S. is going to limit imports of cotton and cotton-made products from Xinjiang for the human rights violations. These are things that are going to push prices higher and make the inflation pinch feel a bit more. But deflation assets continue to outperform versus inflation assets. So at what point do we start to see this pivot where we move away from the deflation fears and into the inflation fears, and you get the pivot into one that's going to be more protective versus the other? And this is going to be an interesting one to watch as we look at the inflation assets being commodities, real estate, tips, which is the inflation-adjusted government debt. These are things that we're going to have to look at to see where are people shifting into, where are people trying to essentially hide overall. So now when we look at consumer prices for selected groups across different countries, Japan continues to be at the lower level in terms of total, but when we look at European 19 countries, food shifting up. That's a problem. OECD total, food continues to pull everything higher, where even on this metric, we have food in the U.S. Approaching 4%. People aren't buying airline tickets. They're not buying concert tickets. They're buying food, and food prices are going up due to shortages, due to logistics, due to supply chain. And when we look at the market, milk, cotton, soybeans, meat, all of these things are driving food up. And when people don't have the wages that they did have, yes, they may have more in savings because they squirreled away some of the money that's come from the government. It's not going to get back into the market because they're feeling the pinch more and more overall. So then when we shift and we look at, okay, well, again, home prices continue to move up as we continue to talk about, which, rents is a different thing, because rents in urban have come down, rents in suburban have gone up because people have moved out of the cities. So you have to look at, okay, well, where are new home prices selling? And this is the underlying problem. Under $200,000 prices are not selling. And it's not because they can't sell. There's just less of them. People have moved into homes, upgraded them, whether they be a flip, adding a second floor, adding a bathroom, doing things to increase the value and moving them into the 300 to 400 to the 400 to 4 and over, and that 200 to 300. There's now less starter homes and more higher priced homes, which again is going to limit the amount of capacity for people to be that second wave of home buying. Because as we've talked about many, many times, we had the strongest move first. They went out and bought homes, and now we're not seeing that second wave because that first wave has already been exhausted. And that's when we look at losing steam. So again, we have to appreciate seasonality. But when asking price growth for U.S. homes has slowed since the peak in July, where now we're not getting the same type of bids. We're starting to see a little bit of a slowdown. It's still strong. We're still up almost 15% year over year, but it's not going above 15%. We're not pushing 16% as we went parabolic from April to let's say July, August. Now we've kind of pared back, and we're still seeing an easier comp Jan over Jan, which even though seasonally adjusted, it's still strong. It's just, where are we going to get the next pop in the spring, summer, when we get into that core U.S. home, essentially real estate sales? And, in my opinion, the answer will be no. But when we look at national HPA, this is up from 9.4% a month ago and 6% a year ago. So the National Home Price Association for November averaged 10.3%. Again, this is a calculation into inflation. This is where we continue to see the inflation move. HPA is projected to accelerate to 11 to 12% range in December and 12 to 13% in January and February. Again, moving all of these things higher, and the year-over-year rate is going to be a much bigger problem when we look at what is the spending power of people. And when we look at, again, bank reserve distribution, when we look at the long versus the DOM versus the FBO, this is where we continue to see this bifurcation, and there's going to be a snapback. The question is going to be, that one won't meet the other. They'll meet each other somewhere in the middle, and it's going to be a much bigger shift in distribution, which should put more money in circulation. But again, it will also be beneficial for banks. But the question will be, how are bank reserves being moved into the market? Because large businesses continue to get a lion's share of it versus the small businesses. But we'll start to see some of this converge, which will put more money in circulation, increase inflation. Again, coming back kind of full circle, which is when we look at the GDP year over year versus employment, you continue to see employment year over year really lagging on the, sitting at about 6.5%, just as GDP year over year is sitting within, about negative 3%. These are the problems when we look at how is GDP going to recover in Q1, given that Q1 is going to be a harder comp given when we went into lockdown, when we had our issues in March. So you had two and a half months of okay activity, which again is going to make this comp much harder. And then the question is, will we start to get something better as we go through into the new not only into Q1 but into Q2. But when we look at jobs in the lockdown recovery versus the recession, this is where we continue to see this rollover, and there's an expectation in the market that we're going to start to get an acceleration into February. And I don't, when we look at the data so far, the high frequency stuff, all of the leading indicators, it's going to be a bit slower than that, and it's going to take, I think, more time to cross back over and to start to get into some recovery mode, as you can see what it took for the recession, just because COVID, again, was the excuse to let people go. And now that companies have started to make a little bit of a profit, starting to get their legs underneath them, they're not going to be quick to hire people, which is why we think that this is going to be a problem as we head into not only into end of Q1, but well into Q2, Q3. But credit card spending, again, remains. Warehouse clubs continue to see the bulk of it, especially as we have concerns about renewed lockdowns, people looking to stock up. Where's the best place to stock up within a warehouse club? But all categories on spending continue to trend higher, which again is a net positive. And it's just, what are people spending on? And again, they're spending on goods, not airlines, not concerts and sporting events, but on food, on these different components. And you can see how we continue to be elevated overall. But change from 1 year earlier, again, it was, we still had a decently hard comp, but we still see this growth. But we have to think, okay, the 4-week moving average, is this going to move down or up? And just based on what we're expecting, given the 4-week average is picking up shopping, this will start to roll over, and we'll talk about that more in the next segment. And then when we look at, when we start talking about inflation and inflation adjustments, well, what does that mean? Well, that's when we start to talk about Bitcoin. Some of the bigger issues when you look at Bitcoin, which has been fairly closely tied to gold movements, 95% of Bitcoin supply is held in about 2% of the wallets out there. And that's, now, is Bitcoin good or bad because of that? It's more about, you don't know what those 2% of the people are going to do. If one of them decides to unload 100% of their wallet, you're going to see an extreme, because there's air pockets both up and down. And that's where we get this concern until we start to see some of this normalization, as some of these individuals maybe capitalize, maybe try to make some, take some risk off the table, or maybe they're holding out for that 100,000. These are going to cause air pockets to happen within within the market. So it's just a component of treading with caution in general. And then when we look at just Bitcoin number of active addresses, you can see that there was a huge increase in just activity as more people activated, their addresses, and then just open up their wallets, looking to get active. And you could see that every time we get this surge in activity, it always culminates in kind of this peak and then a quick trough of activity, and then it starts to pick up again. So this is something to watch if you're considering getting active in the Bitcoin market. Again, we've done a lot on smart contracts and the underlying components behind Bitcoin, Ether, and other, because there is a value in the ledger system. The question will be, from a front end side on what Bitcoin and some of these others reside in. The bigger issue is going to be emissions when we start looking at some of this inflation push through, because emission contracts are increasing in terms of price, and the emission contracts are things that people have to buy to offset the emissions they're pushing out. And this will just be a natural tax to the consumer, because they will just pass through that cost. And so if emissions have increased, so have the cost of the contracts and the amount of contracts. But if you want to do something to avoid that, and this is something we'll talk about in a bit more detail at another point, electric cars boost metal demand, and you can see what the expectations are for the demand in these goods into batteries. And that's why when we look at the competition for batteries, as the cost of emissions goes up, as the costs start to increase, how do you start to offset that when you have a big demand surge? Because more and more things are competing for batteries. It's not just cars, it's everything from lawnmowers on down, which will impact, unless we get a big step change in battery technology, raw material prices will go up. Nickel, aluminum, phosphorus, iron, copper, all of these things continue to shift higher. And as I was talking with Matthew Warder, we were talking about copper, like when you look at copper versus cobalt, well, cobalt normally comes with copper. So if you increase copper mining, you'll increase cobalt, which will offset some of the pricing increases. But again, this is why we've seen some of these increases, which will be a problem in general. But when we look at kind of wrapping it up, container shipment costs continue to rise. Cost to ship a 40-foot container from Shanghai to LA has flattened out, but again, it still remains elevated. Cost from Shanghai to Rotterdam has exploded. This, again, comes down to inflation, comes down to prices that will be passed on because there's a rush to get these goods there. There's a rush, and they're going to pay these prices because of the supply chain issues. There's a shortage of empty containers. How do you backfill? And this is becoming a much bigger problem as we look at pricing in general. And even though this looks good, orders placed, there are just not a lot of new ships being delivered, being ordered, because it's already a saturated market that was really saturated, as you can see, from 2005 essentially through and including 2006, 2007. Then you had this drop off, but based on the new emissions coming out, the new issues on emissions in general, as we showed about that contract. Are you in any rush to build a new boat? Like, are you in any rush or are you going to wait to try to see what the new innovations are and then try to high grade your system to reduce emissions that way and try to do, and again, maximize your current capacity? Because we haven't seen shipping rates at these levels in a long time, and they're trying to now recoup and pay down debt, or I know shipping companies tend to be more trading vehicles than investments because, paying down debt is a dirty word for some of them. And again, these are those concerns. But again, this is where we continue to see there won't be a new orders placed. There'll be some retirements. There'll be scrap, and that will keep these prices elevated. Again, pushing inflation higher, which remains a concern as we start to talk about now and in the next segment going into jobs and how is the underlying U.S. consumer feeling and looking to spend through not only Q1, but at least into Q2 and beyond.